Imagine a world where the S&P 500, the golden goose of stock market returns, limps along, yielding a mere 3% annual return for the next decade. For context, that's less than half its historical average. What would Warren Buffett, the oracle of Omaha, do in such a scenario? More importantly, what should you do to not just survive but thrive? Stick around as we dive deep into Buffett's time-tested strategies to outsmart a low-return environment. You'll hear powerful stories, actionable advice, and the mindset shifts you need to make the next 10 years your most profitable yet. Why a low-return decade might happen? The prospect of a low-return decade for the S&P 500 might seem far-fetched, especially when many investors have been conditioned by years of strong market performance. But beneath the surface, the warning signs are becoming harder to ignore. Even Warren Buffett, the oracle of Omaha, has hinted at the likelihood of such a scenario. To understand why this might happen, we must delve into the underpinnings of the market today. First, consider the case of the dot-com bubble in the late 1990s. Back then, exuberance for tech stocks reached such a fever pitch that companies with no revenue, no profits, and unknown products were trading at astronomical valuations. Investors were blinded by the promise of future growth, paying little attention to actual fundamentals. When the bubble burst, it didn't just take down high-flying tech stocks, it led to years of underwhelming returns for the broader market. Today's parallels can be drawn. While many companies are fundamentally sound, the valuations of some sectors, particularly tech, have reached levels that history suggests are unsustainable. Another contributing factor is the prolonged era of low interest rates we've experienced over the past decade. Cheap borrowing costs have inflated the prices of assets across the board: stocks, real estate, even cryptocurrencies. But as rates rise, the cost of capital increases, and businesses face mounting pressures on profits. Consider the real estate market in 2008, where inflated asset prices and rising interest rates collided disastrously. The fallout wasn't just contained to housing, it rippled through the global financial system, leading to an extended period of sluggish returns. Warren Buffett has also emphasized the importance of corporate earnings in driving market performance. But what happens when economic growth slows? With the world facing geopolitical tensions, supply chain disruptions, and inflationary pressures, many companies are struggling to maintain the profit margins they enjoyed during boom times. History reminds us that even giants can falter. Look at General Electric, once a stalwart of the American economy. Overpriced acquisitions and changing market dynamics led to its decline, erasing decades of shareholder gains. Buffett often warns about the dangers of reversal to the mean. After years of above-average market returns, the pendulum typically swings the other way. For investors, this doesn't signal doom, it signals the need for a shift in strategy. The forces at play today, stretched valuations, rising rates, and slower earnings growth, are all reasons why the next decade might not mirror the boom markets of the past. If you're enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start a financial journey. Buffett's playbook for a low-return market. Warren Buffett has spent decades navigating markets through booms and busts, bull runs, and bear crashes. When he speaks about preparing for a low-return market, his advice isn't based on speculation. It's rooted in battle-tested strategies that have stood the test of time. Let's dive into his playbook and see how he can transform uncertainty into opportunity. Buffett's first rule is deceptively simple. Know what you are buying. Take the story of Coca-Cola, one of Buffett's most legendary investments. In the late 1980s, many dismissed the stock as boring. Yet Buffett saw something others didn't: a strong brand, consistent demand, and immense pricing power. Decades later, while the broader market faced turbulence, Coca-Cola delivered steady returns, underscoring Buffett's belief in holding quality businesses. Even in a low-return environment, only companies with a durable competitive advantages can safeguard and grow your wealth. Then there's the lesson of staying patient. During the dot-com bubble, while investors poured into flashy tech stocks, Buffett famously stayed away, calling them speculative bets. People mocked him, labeling him out of touch. But when the bubble burst, his discipline paid off. Instead of chasing fleeting trends, he focused on his core principles, buying businesses with strong earnings potential and predictable growth. That patience allowed him to pick up undervalued stocks like Apple years later, turning them into some of Berkshire Hathaway's biggest success stories. Cash, often dismissed as dead weight, is another cornerstone of Buffett's strategy. In a low-return market, cash isn't just a buffer, it's a firepower. During the 2008 financial crisis, when others scrambled to sell, Buffett deployed billions into companies like Goldman Sachs and General Electric. His mantra, be fearful when others are greedy, and greedy when others are fearful. That same cash-first philosophy enabled him to strike lucrative deals when the world seemed on the brink of collapse. Also, Buffett reminds us of the power of reinvested dividends. The story of Procter & Gamble, another Berkshire holding, illustrates this perfectly. Over decades, its reliable dividends compounded over time, generated massive wealth. In markets where capital appreciation slows, dividends become a critical engine of growth. Buffett's strategies aren't about trying to outsmart the market, they're about embracing its realities. By focusing on quality businesses, practicing patience, keeping cash reserves, and harnessing the power of compounding, his playbook equips investors to weather the challenges of a low-return era while positioning themselves for long-term success. What you can do to stay ahead. Thriving in a low-return market requires a combination of discipline, adaptability, and a long-term mindset. Warren Buffett's timeless advice serves as a beacon for those navigating such challenging waters. His philosophy isn't rooted in complex formulas or Wall Street jargon. It's built on straightforward principles that reward patience, preparation, and strategy. Let's look at the story of a couple, Mark and Linda, who faced the aftermath of the 2008 financial crisis. The retirement savings had taken a hit, and panic was the natural reaction. But instead of withdrawing their investments and locking losses, they turned to Buffett's wisdom. They doubled down on their research, focusing on companies with strong fundamentals, brands that were household names with consistent earnings and robust management. Over the next decade, their investments recovered and grew steadily. What Mark and Linda did mirrors Buffett's own approach. When the market is uncertain, look for quality at a bargain. Another powerful lesson for Buffett is to embrace the power of compounding. Sarah, a school teacher with the modest earnings, knew she couldn't predict the market, but she could control her savings. Every month, she set aside a portion of her paycheck, investing it in index funds that mirrored the market. Even in low-return periods, Sarah's strategy paid off because she never stopped investing. Over 20 years, her disciplined contributions grew exponentially, highlighting Buffett's principle that timing the market beats timing the market. Diversification is another pillar of staying ahead, especially when returns are slim. Buffett cautions against over-diversification but emphasizes spreading risk intelligently. Take the case of Rafi, a young investor who pushed all his money into tech stocks during the dot-com boom. When the bubble burst, he lost everything. Learned from his mistakes, he rebuilt his portfolio with a mix of dividend-paying stocks, bonds, and international funds. This balanced approach not only mitigated his risk, but also ensured steady returns during turbulent times. Buffett also underscores the importance of managing expenses. Living below your means isn't just practical advice, it's a strategic move in the low-return environment. Karen, an entrepreneur, decided to downsize her lifestyle during a market slump, reallocating the savings into her portfolio. That sacrifice allowed her to invest consistently regardless of market conditions. By avoiding unnecessary expenses, she strengthened her financial position, echoing Buffett's belief in the value of prudence. Also, investing in yourself is non-negotiable. Buffett himself reads voraciously, soaking up knowledge to refine his decision-making. Take John, an experienced investor who used downturns to enroll in financial courses and devour books on investing. That knowledge didn't just boost his confidence, it armed him with strategies that outperformed his peers. Staying ahead often means staying informed, understanding the market's nuances while resisting knee-jerk reactions to every headline. The common thread in these stories, they reflect Buffett's enduring wisdom. Don't chase what's flashy or panic at the first sign of trouble. Instead, focus on what you can control, your research, discipline, and long-term perspective. Even when the market offers just 3% returns, these principles ensure you are maximizing every opportunity. Staying ahead isn't about beating the market, it's about positioning yourself to win, no matter what it throws your way. If you like this type of content, then press the like button and subscribe to our channel.